Peter Rose, Longwood Currency Trading. Don't use indicators during your entry analysis stage of the life cycle of your trade. Just don't do it. In this video, I'd like to get some background for you on why I believe that's the case and a solution for maybe when indicators are appropriate, but what to do during your entry phase. But first, I think this is empty. This coffee cup is empty. Empty doesn't do me any good. We're going to get some coffee first, and then we'll go from there. Okay, I got the coffee. Don't use indicators during your entry analysis, okay? You might, before you start, you might notice that I've done the last few videos here in the kitchen. I'm swooping in and out for coffee quite a bit, and the library is just a wreck. I'm working on 4 different projects. The other day I mentioned the computer programming project for staging in lots into a position. I had said that I had, and I was building a little bit off of the programming that I had used for the staging out process, just doing some simulation analysis for some of the stuff that I'm trying out in real time with a 6-figure account. So it's not like I'm going to be wasting your time talking about it or my time actually doing it. And other things. I'm working on some coursework and educational work and communicating with folks through email on some of the thoughts that I've shared with you guys in these videos. I really appreciate the subscribers and those of you who do send me serious emails asking questions, and most of the time I can help you and resolve the particular issue that you're having, no charge or anything like that. If you get to a point where you think you need more in-depth consulting work or courses or stuff, then we can talk about that. But I'm not in this game to sell you courses. I don't have anything to sell you unless you want it and need it from me, and then we work together on that in order to put a curriculum together for you that's reasonable for the amount of time that you want to spend in doing it. But things like this issue about using indicators, well, I'm not a big fan of indicators to start with because they're what happened in the past. Using an indicator is like going up and putting your hand on a railroad train track and feeling that it's warm. Now, you don't know that it's warm because the sun has been beating down on it or because a train passed. If a train did pass, you don't know which direction that train went in. You don't know how big the train was. You don't know how many cars there were. You don't know what the purpose of the train was for. You don't know the products that were in the train, whether they're hazardous materials and some of it might have spilled on the tracks. You don't know. But you know what you do know, or you should know, is that you keep leaning over that track with your hand on that rail. There'll be another train that comes along and it'll run you over. So looking at that past heat on that rail doesn't tell you anything. And in fact, the more you study that rail, the more likely it is that the next train is going to roll you over. And this is what my gripe with indicators is at any stage of the life cycle of a currency pair. A currency pair goes through 3 phases. You have your entry analysis phase, you have position management, and you have exit methodology. Those are the 3 phases of the life cycle of a currency pair. It's taken directly out of my 33-year career as a senior software engineer designing complex internet-based enterprise business applications. Now, you'll note from my website, longwoodcurrencytrading.com, that it's not the most attractive website that's out there because I'm not trying to sell you anything. I'm not trying to draw you in. My experience has been in informational websites from a career, from a commercial career, informational websites and what we call back office operations, accounting procedures, business operations, internal operations, that sort of programming development, rather than client facing. Designing a website so some fool can buy a pair of boots on the web. I didn't do very much of that. I didn't do very much client facing stuff. But you'll note that the informational content of that site guides you to understand that I'm a principle-based, not only educator, but trader. I base everything that I do on principles. And having the life cycle of a currency pair is very similar to the work that I did as a business application software development engineer, in that you would have a life cycle of the development of that product. You did your analysis first, you did your prelim client sign-off work, you did your preliminary screen development, and then you go back and get sign-off from the client, you do your updates on the next iteration, and then you'd go from there. So there's a process in software development. There's a process in solving mathematical equations. There's a process in looking at the world around you, the nature, and explaining that through the laws of physics, right? And so it's no different than when you are looking at the complexity of the currency market. As I mentioned the other day, the currency market is complex, but trading it is not complex. And it's not complex if you do have things like the life cycle of the currency pair. So you can break the problem up of trading into solvable pieces. So I've broken it up into these three pieces. The first being that entry analysis stage. Now, if you take the analogy of the railroad tracks to entry analysis, you immediately see what the correlation is. I think it's important for you to think about that for a minute. Wind the video back and listen to the example again, and see if you can't make that correlation, and if that doesn't make sense to you. If it does make sense to you, then you say, well, why are all these indicators out there? Well, it's done by academics. It's done by people that got successful in their trading, but they didn't really understand how that success came about, and so they used stuff like Bollinger Bands and moving averages and RSI and stochastics and the Fibonacci dance of death crap. It's a way for people who can do something but not necessarily have the skills to break it down so that it makes sense to somebody else. So you have these indicators that appear to follow certain patterns that you can use from a predictive standpoint. You can't. An indicator is the result of something. It doesn't create the success. It doesn't create the next event that's going to happen. It is only a representation of what happened in the past. It's a representation of the result, not the creation of something. Those are two really important concepts to grasp. The indicators are the result, not the predicator, the predictor of something. It may be very tough for you to believe that. It may be because where else do you go to grab onto something concrete to say, oh, I got the secret sauce, I got the thing here, I'm going to use a moving average crossover system with an 8 fast and a 21 slow. It isn't like that. Trading is like art. In art, if you're going to draw, you have your focus lines, your diminishing lines, but those are subjective. the size of the stuff that you put along those lines is subjective. It's not objective. Not everybody can paint like Picasso or Norman Rockwell. It's stylistic. Well, how do you learn it then? Well, you learn it by understanding the fundamentals. How do you mix paints? How do you draw those lines? How do you blend colors together to make the difference between painting someone's face as opposed to painting trees in the background? How do you differentiate your trading? Well, break it down into two simple pieces. The price is either trending or it's chopping. What do you want to do? You trade those basically the same, but you have to know the difference in when you apply the rules that you're going to have. That's the secret sauce. Well, what's the rule? Well, the rule doesn't make any sense in telling you what the rule is because it's subjective, not objective. It's not dogmatic. It's not when this happens, then you do this. It's looking at a Monet painting and saying, oh, that's a girl in a field of flowers. But that was painted with just little dabs of the brush. There were no brushes. And so if you get up really close to it, all you see is a bunch of dots and it's all fuzzy and blurry. But you step back and it's magnificent. The currency market that's representative in the chart that you're looking at is the same thing as that Monet. You're not going to understand how to paint the Monet by looking at one dab or saying that you put these 5 dabs in a row and this one's blue and this one's green and then you mix them. How well do you mix them? That's experience. So you just may not be cut out to be a currency trader unless you have somebody that knows how to work with your particular educational background, your particular personality backdrop. Do you see anybody out there teaching classes that would ask you either one of those questions? I don't think so. So, you either learn this stuff from somebody who knows what they're doing, or you figure it out for yourself. But please, in the process of figuring it out for yourself, save yourself literally years and tens of thousands of dollars of lost money and time by using indicators. Better that you don't use indicators at all in your trading, learning how to trade, than to think that any one of them is going to help you. Rely on the price action itself. You know, there's a branch of FOREX trading called naked FOREX trading. It doesn't mean you're naked, although it could be. It means that there's no clutter on your charts. The more stuff you put on your charts, the more confused you're going to get. As you know, in many of my videos, because of my mathematics and physics background, I understand probability and statistics. If you there's a branch of mathematics called combinations and permutations. A permutation is if I have two things, A and B, then there's 4 ways I can arrange those 2 things. I can have A by itself, I can have B by itself, I could put A and B together, or I could put B and A together. So by having 2 things, I have 4 potential combinations, right? If I have 3, it jumps to 21. If I have 5 objects, there's 325 different permutations you can put those 5 objects in. So if you think you're going to put 3 or 4 or 5 indicators, and it's not hard to get them, moving averages, RSI, Bollinger Bands, Fibonacci fucking Dance of Death, you're very easy to get to 5, to think you need 5. And you're encouraged to use 5 so that you get this stupid concept called, what is it? Confluence. Oh my God. If you have 5 indicators on your chart, you have 325 possible decisions as to the weight that you want to apply to each of those indicators, or if you're going to use it in the particular situation that you're in. Do you see how stupid that is? If you can't see how stupid that is, you best go and play racquetball and not risk your life trading currencies. This is serious stuff. You can make as much money as you possibly humanly could conceive of making with absolutely no limit and no advanced education, nothing. You just have to have a will to do it and the courage to sell the truck and to live in a less expensive apartment. And instead of going out to dinner 4 nights a week, don't go out to dinner at all. Learn how to cook. And save thousands and thousands of dollars a year so that you could put those into your trading account. And get to a point where that money that's coming off from that trading is so consistent, the money that you're earning is consistent, that you know within a standard deviation or so of the mean how much you're going to be making from your trading. If you have a good win-to-loss ratio, that's that indicator. If you have a consistent win-to-loss ratio and you're making $10,000 a year off of your trading on a X level bank, multiply that bank by 3 and you increase your profits by 3. Which means that because you know within a standard deviation of the amount of money that will be generated, and it's going to be a net amount, you can, once you get your bank large enough where you're producing trading that you're making $500 a day, let's say, you don't need to increase the size of your bank once your trading gets to $500 a day. $500 a day, 5 days a week, so that's $100 grand a year. How do I know that? Because that's what I made. I made over $100,000 a year as a software engineer. So I have that in the back of my mind. I know what this stuff is. You can live pretty good on $100,000 a year. You can live pretty good on $30,000 a year if you know what you're doing. So when you get your trading account up to the point where you're consistently throwing off $10,000 or $15,000, you don't have to worry about eating into the principal of that unless you could do something stupid. Well, then you're going to pay the price for that anyway, whether you take money out of the account or not. So once you get your trading account to the point where you're making a decent amount of money, you can pull that money out and start to live on that money. And by living on that money, a certain percentage of that goes into savings. Buy T-bills. Be safe about it. Right now you're making 1.5%. As the interest rates go up, you invest that money, that'll be paying you maybe not as good of a return as you want. So add in, buy more D-bills, buy bonds. You know, take that savings and get it out of your trading account so that if one day you have a stupid attack, or like the little bridge troll Ed that I talk about, he sits right here on my left shoulder and he whispers in my ear to do stupid shit, and it always costs me money. That money will be out of your trading account so you don't have it to trade with to lose. And then when you get really good and you've got $40,000 or $50,000 in your savings and you're totally confident about that, take the $50,000 and put it into your account. Now you're trading maybe a 6-figure account. That's the way that you do it. But you don't do it using indicators. Do not use indicators in any part of your trading. Now, as you become more advanced, some of those indicators, and I put some in quotes, like 3 of them, may be applicable in certain, you hear me? Certain circumstances during the position management phase of your life cycle of a currency pair. And some, under certain conditions, may be applicable in the exit methodology. But none of them are applicable in the entry analysis stage of your trading. Don't use them. And anybody that's suggesting to you that you do does not know how to teach whatever it is that he does to be successful. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.